He is John Richards, head of strategy for the Americas at RBS Securities. John, first of all, it's great to have you here. It's been a while since I was on your trading floor, and we had a great time over there in Stamford. Let's talk quickly about the gains that we're seeing here, because it's sort of a slow but sure climb that we continue. Now another 18-month high, the S&P 500 at 1173, 1174. The Dow within striking range of 11,000 at 10,910. What is it that continues to drive this market higher in the face of all the headwinds that you constantly hear about on shows like this and read about in all the newspapers?
Well, the headwinds are awfully obvious, and there are a multitude of them. What's not so obvious but is driving the market, I think, is the very strong profits recovery that we've seen to date, and more importantly, the outlook for further gains, which I think is very positive.
Are you concerned about the danger, John? I mean, with low volume, people always say you could easily retrace the gains that you've made. Is that a concern for you?
Well, I think it always is, especially as you're up around the highs. On the other hand, this market has really shown itself to be sort of a Teflon market, and I think there's an equal probability that you could have a gap on the upside as this thing takes hold, and people who have been out of the market waiting for that pullback finally throw in the towel and realize they're not going to get it.
Hey, John, you an iPhone user?
I am. My wife more than me.
Your wife more than everyone's using these things. What do you think about the stock, though? I mean, Apple hasn't had a bad run, but technology has really underperformed other sectors in the market, and it's been the darling of all the money managers that come on this show. It just hasn't really caught up this year.
Yeah, I understand, but I think that's partly a reason more why the industrials have done so well. There's more scope there for massive gains from restructuring. We've seen that over the last 18 months, and now the dividends are starting to be earned in terms of increased earnings potential. So while the technology has done well, it's just that industrials have done so much better because they've had so much gains from cost cutting, which allows them then to have this so-called operating leverage, which means small top-line sales growth results in large bottom-line earnings expansion.
All right, John, let me ask you, because, you know, I feel like you're an expert on the bond market. Not that you don't have expertise other places as well, but last week we had some problems in equities, and it was blamed on a couple of lousy auctions for bonds. What kind of effect do you see bonds having on equities going forward? Because we've had some big bond gurus come out and say, at least there, in some places, the run is over.
Well, I think that last week we saw supply pressures, frankly, that we'd expected to see over the whole coming quarter.
Finally.
Materialize in 2 days and get priced in the market. The bond market, to me, has now re-rated itself to upcoming supply pressures. The important thing, I think, for the equity markets are two. The Fed is by no means yet ready to tighten credit. That comes at the earliest in September and possibly as late, we think, as January. As long as the Fed continues to ease, there's ample liquidity, overall low rates, and strong earnings. And that's a great environment for the stock market.
What about, you know, tomorrow we see the end of the Fed buying in mortgage-backed securities. Is it a concern?
Not a big concern. We think that largely already priced in, maybe small upward pressure on spreads to treasuries, but not a lot. And there's plenty of investor demand for anything that out-yields a U.S. Treasury at this stage.
All right. Hey, John, thanks so much for joining us. John Richards, head of strategy for RBS.